question, right? And maybe we can think about this as the elephant in the room, or one of several elephants maybe, depending on the questions that everybody is interested in. But certainly a very basic question about where we are. And that's simply, are we in a recession? Right? Very straightforward question, very simple question. What's going on right now, and is the US economy currently in a recession? Now, why is that a question? Normally, that's a pretty obvious answer. It doesn't require a whole lot of discussion. But one reason why this is a question that's coming up now is because if we look overall, we can see some contractions in different markets across the US, and certainly that's the case in the housing market right now that we're all aware of. And more generally, we see it in the data. So if we look at GDP growth in 2022, we can clearly see that there have been two consecutive negative quarters of GDP growth. As you see here, negative 1.6% in the first quarter, negative 0.9% in the second quarter. And two negative quarters of GDP growth back to back is the unofficial, or the more rule of thumb definition for an economic recession. So we look at that and we say, well, yes, this suggests that we are in a recession. Two negative consecutive quarters of growth for the first half of 2022. However, if we look more broadly, it begs the question, though, of why that's then a discussion at all, if this is the case. Well, the official definition of recession is a little bit different. So this is the rule of thumb definition that a lot of people use. But the official definition comes from the NBER, the National Bureau of Economic Research. And they use a variety of economic metrics, including GDP growth. But they also look at things like the labor market, the strength of the labor market, inventory levels. They look at retail sales. They look at a number of different macroeconomic factors when evaluating the state of the economy. And they also make a decision about whether to call a period a recession well after the fact. And the reason is that they're trying to put it in historical context with other recessions and trying to really frame it from a long-run perspective. So the NBER doesn't assign a period as a recession or not, usually until well after the fact. So officially, if you're asking the question, are we in a recession? The answer would be, we don't know yet, because the NBER is the one that makes that official decision, so to speak. But nevertheless, this is a good rule of thumb, because two negative consecutive quarters of growth does tend to correlate with a broad pullback in the economy. But this year is also a bit different by this definition too. And the reason is that we have two negative consecutive quarters of growth, but that's happening at the same time as we see a very strong labor market. And that is extremely unusual. So this is the US unemployment rate that's tracked back, in this case, to the early 1970s. The recessions that are highlighted there in the gray bars, and you can see in every recession, except for what we're seeing this year, we see a significant spike in the unemployment rate. So normally a recession involves a broad pullback in the labor market, and that is not what we are seeing, at least not yet, in 2022. So that's why this unofficial definition, or this rule of thumb definition of two negative quarters of GDP growth, may or may not be appropriate at this time to say, okay, we are definitely in a recession. So 2022 is just a very unique period in terms of what we're seeing overall. But despite that, despite this discussion and this debate about whether we are officially in a recession or not, this question is also very important, and certainly from a much more practical perspective, which is a recession inevitable in terms of what we normally think of as a recession, where we see a broad pullback in virtually all macroeconomic sectors or macroeconomic metrics across multiple industry sectors, including the labor market. Is that likely to happen? Is a recession inevitable? And most economists would say that we are that over the next year, there's about a 50% chance that we will see a recession, a broader pullback, again, a more traditional definition of recession, sometime in the next year. And there are specific reasons as to why that's the case. I think that's probably right. And we can clearly see this if we just look at the possible trajectories that we may see over the next year to year and a half in 2022 and 2023. So we can think about this from the perspective of where we are with inflation. So we have very high inflation right now in the US economy of 8.5%. I'll share some data on that with you in just a few moments. And we have a reaction from the Federal Reserve to deal with this high inflation, and that is to raise interest rates. And so you can think about the trajectory of our economy going forward as taking one of two possible paths. Either we continue to have high inflation, and arguably the Fed, let's say, does either nothing or very little, or they get aggressive and they really focus on raising interest rates to get inflation under control. So the path on the left there, where we just have persistently high inflation, what does that do? What are the practical consequences of that? Well, that begins to erode purchasing power on the part of Americans. That limits their ability to spend, that lowers consumer spending overall. And it also can potentially create what we call a wage price spiral, right? Where prices go up, the wages go up as a result of that to compensate, and prices go up further. And so you get this wage price spiral that keeps inflation elevated. And because of both of those factors happening, you see a reduction in economic activity, right? So that's something we want to avoid, but that would be an inevitable outcome. Alternatively, if we see interest rates rise, if the Fed takes a proactive stance to try and pull inflation back down, we also are in a situation where we could see a decline in economic activity, because raising interest rates raises the cost of borrowing money, right, by definition. And so that limits what businesses can do, and it limits what consumers can do in terms of spending on big ticket items. And that also lowers economic activity. So regardless of which path we go down, it's inevitable that we're going to see some slowdown in economic activity. So that's why when you hear polls of economists and you hear different economists speak, what you'll find, again, excuse me, on average, is that economists would say that there's about a 50% chance of a recession sometime over the next 12 to 18 months in 2022 or 2023. And the shorthand version of this that I like to describe is that the Federal Reserve basically has decided that they're going to throw cold water on a red-hot economy. That is what we are seeing. This is, in a sense, the Twitter version of what's happening in 2022. We have seen a red-hot economy. Demand has been extraordinarily strong. The labor market has been doing very well. And as a result, we see this high level of inflation as the economy has been overheated, and the Federal Reserve is taking proactive steps to pull that back down, to pull us back down to lower levels of demand to get inflation back under control. So in order to get a sense of what this means going forward, particularly for the housing market, I want to take a little more time and talk about both the supply and the demand sides of the economy in terms of what we've seen, the specifics of how we got where we are today, and what we're likely to see as we move forward. I want to start with the supply side, and then we'll move to the demand side of the equation. And the supply side specifically, I want to talk a little bit about the labor market in more detail. So labor supply specifically, because if we think about housing markets in general, the best single predictor that we have for the health of the housing market and for housing demand is the labor market, is job growth, right? Because typically, if you don't have a job, you can't buy a house. Now, employment growth and job gains, that's not the only predictor by any means of the housing market. I don't mean to imply that. But it is the single best predictor. If you're just going to go with one, then employment growth or the labor market more generally is what you need to be looking at and following very closely. So let's look at the labor market in a little more detail to get a sense of where we are and where we're likely to be headed. And as we do that, before we look forward, we need to look back, of course, and we can do that and assess where South Carolina is situated with respect to job gains and job losses following the pandemic. Now, if we go back to 2020, between February and April of 2020, during the COVID recession, South Carolina lost about 15% of its total employment base, which is a pretty striking number when we look back on it, because that occurred, again, just in a very short period of time, in 60 days. That's over 300,000 jobs lost in the state in 60 days. But we also saw a very rapid rebound, which you can see in the green line here. So this is what economists would call a V-shaped recovery pattern, right? A rapid loss in employment followed by rapid recovery. And so as of 2022, as of the summer, we have fully recovered all the jobs that were lost during the pandemic. And in fact, we're about 1.6% higher today in terms of our employment levels than we were in February of 2020. So we have more people working today in South Carolina than we did back in February of 2020. So that's very good news. That's not the case, by the way, at the national level. For the U.S. as a whole, is just barely getting back to pre-recession levels of employment. So South Carolina very much outpacing the national average. And you can also see how this recovery, this V-shaped recovery pattern is very unusual. It's not typical following a recession to see such a rapid recovery. And for context, I want to show you that red line there, which represents the Great Recession from 2008, where it took us about 6 full years to recover all the job losses from that were incurred in South Carolina in 2008. So the labor market, by this measure, is actually looking pretty good. Now we can also break this down into categories, into industry categories as well as regional categories to give you some perspective there. So this looks at the different industry sectors in South Carolina, and I'm not going to go through those individually, but each bar represents a major industry category, and the percentage at the top shows you the current level of total employment compared to the level of that industry from February of 2020. So anything that says 100% means that that industry has either fully recovered or more than fully recovered. It could be more than 100%. That's just where the graph is capped. But basically what you can see here is, except for leisure and hospitality and construction, interestingly, most other sectors have fully recovered. And in fact, construction had actually fully recovered as of December. If I had shown you this graph back at the end of 2021,